since we are with Jubilant, let me now bring on board the management, Mr. Ravi Gupta, CFO of Jubilant Foodworks, who joins us live from New Delhi. Ravi, good morning. Thank you for joining us, Ravi.
Good morning.
Markets are not very happy with your numbers. Let me hear your side of the story.
See, same-store growth had declined in this quarter, and this has been the constant decline for last 4 quarters, starting with more than 20% same-store growth what we had in the Q1, and the Q4 it is 7.7%. One of the big reasons for this decline in the same-store growth has been the slowing Indian economy. Everybody knows that Indian economy has been consistently slowing down, although there are various estimates about the GDP growth. But this factor has been like about 70 to 80% responsible for the slowing same-store growth. We are confident that going forward, slowly the Indian economy will get revived and will grow at higher levels. That has been the prediction from many economists, and we are also confident that in 1 or 2 quarters, definitely we'll see the reversal of this trend. And if this trend reverses, and we are confident that this will reverse, we are hoping that we will next year we'll have about 10% same-store growth, definitely for the full year. Although for a couple of months we are seeing there is no improvement right now. Maybe that it continues for 1 quarter or 2, but we are hopeful that definitely this recovery will happen, and for the full year we'll have a 10% approximately same-store growth for the full year FY 2014.
Is that 10% growth?
Now let me also take you.
Yes, please make your point.
Let me also take you to regarding the margin also. This year there has been decline of the margin about 130 basis points, and 2 reasons which are responsible for this decline of the margin is about 80 to 90 basis points is because of Dunkin' Donuts, their initial operating expenses, and about 40 to 50 basis points is towards the increase in service tax and excise duty which happened during the last year budget exercise. So about 16% same-store growth which we achieved in FY13 has a kind of maintained the margin if we ignore these 2 factors. Now next year when we are saying that there will be about 10% same-store growth, definitely the sustenance of the margin will become a challenge. And let me explain to you a little more here. What happens is when you open a new stores, although about 90 to 95% stores are profitable from day one of the operation, they typically have a lower margin. And why the lower margin is because they have a lower sale initially as compared to the existing stores. When they have lower margins, obviously they will bring down the margins. But on the other side, the existing stores keep on improving the margin because they have been growing at a kind of 16%. Last year they grew at 30%. So there is a balance which gets created between the improving margins by the existing stores and the margin declining because of the opening of the new stores. And there is a balance level which get achieved. Now somebody can ask me saying that, okay, what is that level of same-store growth which balances both this growth? Very difficult, because this will keep on fluctuating from year to year depending on how the economy has been growing, what is the inflation level in the economy, and other various factors.
Right, but for
that is our side of the story.
Sure, absolutely, appreciate it. But for FY14, what would be the average margins or the range of margins that you foresee? One, and you've spoken about 10% growth on the same store sales. Do you think that that's a norm, that from now on it will be 10%?
No, I'm not saying that. We have to estimate what kind of economic growth will be there in the economy, and based on that the estimate for the year to year will keep on varying, and this is the estimate only for the FY14. And we believe that going forward, when the economic recovery happens and we go back to the GDP growth of 8 to 9%, definitely that there will be revival of the consumer sentiment. The strong consumer sentiment will be back, and we will be back to the growth which at higher levels. Now here also I'm not saying that we'll go back to 30% level. Those are unsustainable levels, and we have been always saying that those levels cannot be sustained. But we are confident that we can definitely be much higher than 10% level. One more factor we need to keep in mind, that there has been a service tax which has been applicable to all the air-conditioned restaurants from this year. So there is an additional impact on the consumer, and consumer perceives maybe it's a kind of inflation. So there is a 5% impact also of the service tax on the consumers. So overall, as far as the consumer is concerned, consumer will end up paying like 10% same-store growth, which we are envisaging, plus 5% extra on the service tax.
Well, your comments are helping your stock, sir. The stock has recovered, and it has recovered very smartly in last 10 minutes of trade. Okay, when you say that the total consumer tax has gone up, what I know about Domino's is it's a great franchise, but Domino's or Jubilant Foodworks is known for the delivery model. On delivery based model, the tax has not gone up.
See, there is a confusion right now. There is no clarity as whether service tax is applicable on the delivery sales or not. We had made a representation of the Ministry of Finance to clarify whether the service tax is applicable on the delivery base. On a strict interpretation of the law as it stands, we believe that this should not be applicable, and that is the reason very promptly, immediately after the budget, we have sought clarification. We have also met the ministry officials. However, we are still awaiting clarification from the ministry. The oral discussions indicate that there would not be any respite, but we are hoping that clarification will soon come on this subject, and then as and when clarification comes, we will stop charging the service tax on the delivery sales.
Ravi, on one side, your same store sales have plummeted. On the other side, you've exceeded your guidance of opening up of new stores. So what are you actually trying to achieve?
See, Indian economy has a large potential, and what we are saying is the current slowdown is only temporary. And if we go back to the 2009 when the Lehman Brothers collapsed and overall GDP growth was at similar level kind of, we know that this scenario will be temporary. So we are preparing ourselves for the future growth. And in fact, let me take you that we will be making further investments in our commissaries to support this future growth. Our guidance for the next year in terms of number of stores which will open for Domino's Pizza is 125 stores. We opened 111 stores last year, and we will open at least 125 stores for Domino's Pizzas, additional 18 stores for Dunkin' Donut, and for Sri Lanka also we will open about 8 stores. We are very confident about both this economy, that this economy is going to get revived. They will go back to those levels of 8 to 9% economic growth, and that point of time we don't want to miss the opportunity. Right now the opportunity stands, and we should not get bogged down by the temporary slowdown or temporary reduction in the same store growth, which we believe that will go back to the higher levels. We are fairly confident about that.
Operating profit has also come under pressure due to ongoing expansions. Margins have fallen below 17%. I asked this question before as well. What is the trending range in the margins that you foresee for this financial year?
See, for the last full year, we have a margin of about 17.4%. Although quarter to quarter it fluctuates depending on what kind of same-store growth that we have. And I try to explain to you that when same-store growth has to be a certain level in order to sustain the margin. Last year, at 16% same-store growth, if I ignore those two factors of Dunkin' Donut and additional impact of service tax, we kind of maintain the margins if I just ignore those two factors. Next year, with a 10% kind of same-store growth, our estimate they could be hit in the margin temporarily because the efficiency which will get created by the existing stores will not be large enough that the inefficiency which will get created by the new stores will get absorbed. And we believe that there will be slight decline in the margin and there will be additional decline due to Dunkin' Donuts. We will be expanding Dunkin' Donut to one more region. We have not finalized which region. It will be one large metro cities and couple of smaller cities also will expand. So there will be additional impact of Dunkin' Donut about 10 to 20 basis points, not a large impact. So both these factors together, we believe next year EBITDA will be at least 16.5%.
Ravi, a word on commodity prices. Commodity prices in last 2 or 3 years, they've been strong. But now globally and locally, commodity prices have corrected. So if commodity prices they fall further, are you likely to cut pizza prices or are you likely to retain pizza prices?
See, we are very closely monitoring the commodity prices and our endeavor is always that whenever there is an increase in the commodity prices, we go back to our business partners, and since we have been growing at kind of 40-45% growth on a sustained basis, we ask them saying that you can spread your overheads over this larger volume which we offer to you, and that's why we can reduce the impact of the inflation on the consumers. So while the commodity prices have been going up kind of high single digit and kind of double digit also, we have been increasing our prices about 5 to 6% every year, with the exception of FY12 rather, where we increase prices higher. Now in a scenario when we see the commodity prices declining, although we need to see what are the commodity prices, whether those commodity prices are relevant to us or not, whether they will decline this year. But in case they decline, definitely we have to pass on the benefit to the consumers. We are very cognizant the consumer has to get benefit of all the commodity price decline. But as we see the inflation, specifically the milk price inflation, it has been very benign. There has been kind of very lesser inflation, but the milk prices have started strengthening. About a week back, Amul has increased prices by 2 rupees a litre. Maharashtra dairy farmers have been asking for price increase, and we believe that there could be inflation on the milk, and milk is a very large ingredient for the cheese, and we believe that cheese prices may also go up. In that context, we do not foresee that commodity prices which are relevant to us will have a lower impact. We are expecting that about 5 to 6% impact, or maybe slightly higher impact will be there during this year.
I may have asked you this question earlier, but just for the benefit of our viewers, what is your current agreement with Domino's? What I'm trying to understand from you is that what is the total license fee which you pay to Domino's every year, and when is that contract up for renewal?
See, we pay two kind of fees to them. One is franchise fee, which is about 3% of all the sales which we have, and second is a store opening fees, which is a $5,000 per new store opened. This is payable one time in the life of the store. So these are the two stores fees which are payable. The current agreement is for 15 years, which is due to expire on December 2024, with a right of renewal for another 10 years with us.
All right. Thanks very much, sir, for joining us and giving us that perspective, Mr. Gupta. Appreciate your time this morning. Thanks for giving us more details on Jubilant FoodWorks earnings. The STFC deal that you just saw with Piramal Group stepping in and buying TPG's stake, Yatin joins us with more perspective on that deal. Yatin.
Clearly, Tanveer, ETNOW was the first